All right, let's dive right in. Today, we're getting into the real engine room of building wealth, because it's not just about what you make, it's about what you actually get to keep. We're going to break down 5 really powerful moves you can make to slash your tax bill and seriously speed up your wealth building. And this is all based on what the top financial minds are saying.
Okay, so let's get into this. We spend so much time and energy trying to pick the perfect stocks or find the next big thing, right? But here's the deal. We all have this silent partner in our investments, and that's the tax man. The impact this has on your growth is something the pros call tax drag. And honestly, it's like an anchor on your portfolio. This unseen force that can be one of the biggest roadblocks to building real long-term wealth.
It's a question you've really got to ask yourself. Just picture this. You're trying to fill a bucket with water, but there's a small hole in the bottom. You can pour water in all day long, but you're always losing a little bit. That's exactly what tax drag is. It's this slow, quiet leak that, over 20 or 30 years of investing, adds up to a shocking amount of money. Money that you never got the chance to compound.
Now, if you want to really see this hidden cost of taxes, there's a super simple trick for it. It's a little back-of-the-napkin formula called the Rule of 72, and it's an amazing way to think about this stuff. All you do is take the number 72 and divide it by your annual return. So let's say an investment is earning 8% a year. Well, 72 divided by 8 is 9. It'll take about 9 years for your money to double. Simple, right? But what happens when taxes take their cut?
Okay, just look at how massive this difference is. Let's say you're getting a solid 7% return. Using our rule of 72, your money doubles in about 10 years. Not bad. But if you're in a 25% tax bracket and those gains are taxed every year, your real after-tax return is only 5.25%. Suddenly, it takes almost 14 years to double your money. That's almost 4 extra years your money could have been compounding for you, but instead it went straight to the IRS. That is the absolutely devastating power of tax drag over the long run.
So the big question is, how do we fight back? How do we plug that hole in the bucket? Well, our very first move is all about building a strong defense, and it starts with accounts that a lot of us already have set up through work. The most straightforward, most powerful way to save on taxes right now is to contribute as much as you possibly can to your traditional 401k. Every single dollar you put in is pre-tax. That just means it comes out of your paycheck before the government calculates your income taxes. So it directly lowers what's called your adjusted gross income, or AGI, for the year. And that could actually be enough to drop you into a whole lower tax bracket. So the most important thing is to know what the limits are so you can take full advantage. For 2025, you can put in up to $23,500. Now listen to this. If you're 50 or over, the government lets you play catch-up and put in an extra $7,500. But thanks to a new law, the Secure 2.0 Act, there's a special super catch-up for people between 60 and 63. The thinking here is pretty smart. People in their early 60s are often in their highest earning years, and they're right at the retirement finish line. This gives them one last massive boost to really pump up their savings when it matters most.
All right, on to move number 2. This is a strategy that so many people miss just because of its name. They think of it as just a health account, but really, it might be the single most powerful wealth-building tool out there, a way to turn a simple health plan into a retirement super account.
Financial experts don't throw around words like potent lightly. When they say stuff like this, you should listen. They're talking about the Health Savings Account, or HSA. The only catch is you need to be enrolled in a high-deductible health plan to get one. But if you are, you've basically unlocked what many people call the ultimate retirement account, simply because its tax benefits are second to none. It's known as the triple tax advantage, and this is what makes the HSA so amazing. First, your contributions are tax-deductible, just like a 401k, so that lowers your taxes today. Second, the money inside the account can be invested and it grows completely 100% tax-free. And third, this is the kicker. When you take the money out for qualified medical bills, it comes out completely tax-free. Seriously, no other account in the entire U.S. tax code has that incredible combination.
And you can put a good chunk of money in here. For 2025, if it's just you, it's $4,300. For a family, that number jumps to $8,550. Plus, if you're 55 or older, you get to add another $1,000 a year. But here's the real pro move. This is the secret that turns an HSA from a simple health account into a stealth IRA. If you can possibly afford it, pay for your doctor's visits and prescriptions today out of your own pocket. Don't touch the HSA. Just save your receipts and let that money stay invested, compounding with that triple tax advantage for years, even decades. Then, in retirement, you'll have this massive, tax-free fund waiting for you.
Okay, let's get into our third move. And I'll admit, this one is going to sound a little backwards at first.
I mean, why would we ever want to focus on our losses? But believe it or not, when it comes to taxes, strategically taking a loss in your portfolio can actually be a huge win for your bottom line.
This strategy is called tax loss harvesting. And just a heads up, this only works in your regular taxable brokerage accounts, not in your 401k or IRA. The idea is pretty simple. You sell an investment that's currently in the red, it's worth less than what you paid for it. Doing that realizes the loss for tax purposes. You can then use that loss to cancel out any capital gains you have from selling other things that made a profit. It's a dollar-for-dollar cancellation. So if you made a $2,000 profit on stock A, but you have a $2,000 loss on stock B, you sell stock B, harvest that loss, and boom, it's like the $2,000 gain never even happened in the eyes of the IRS. No tax bill.
But, and this is a big but, you have to be super careful about something called the wash sale rule. See, the IRS isn't dumb. They know you might sell a stock just to get the tax break, even if you still think it's a great long-term investment. So this rule says you can't sell something for a loss and then turn right around and buy it back immediately. You have to wait 30 days. And that also applies to buying something substantially identical. That part can get a little fuzzy, but basically you can't sell one S&P 500 ETF and immediately buy another one from a different company. It's better to play it safe here.
Now, the power of this strategy doesn't even stop there. So what if your losses are actually bigger than your gains for the year? Well, after you've wiped out all your capital gains, if you still have losses left over, you can use up to $3,000 of them to reduce your ordinary income. We're talking your salary. And this is huge because your salary is usually taxed at a way higher rate than your investments. And what if you have more than $3,000 in extra losses? No problem at all. You can carry them forward to use in future years. It's pretty amazing.
Okay, time to level up. We've covered the fundamental building blocks. Now we're moving into our fourth section, which is all about the advanced stuff. These are the next level techniques for people who really want to fine-tune their entire financial setup for maximum tax efficiency.
So we're looking at two really powerful ideas here. First up is asset location. Now, don't mix this up with asset allocation. That's about what you own. Location is about where you own it. Think about it. Some investments, like corporate bonds, generate a lot of taxable income each year. They're tax inefficient. The smart move is to stick those inside your tax shelters, like your IRA or 401k, where you don't get hit with taxes every year. Meanwhile, your tax-efficient stuff, like growth stocks you want to hold forever, can go in your regular brokerage account. Next up, the backdoor Roth IRA. This is a famous workaround for high-income earners who make too much money to contribute to a Roth IRA directly. It's a two-step dance where you contribute to a non-deductible traditional IRA and then pretty much immediately convert that money over to a Roth IRA. It gets you to the same place, that amazing tax-free growth.
So here's the thing. With these more powerful strategies comes more complexity. You have to be careful. For example, that backdoor Roth IRA has a huge potential trap called the pro rata rule. If you already have a big traditional IRA with pre-tax money in it and you try to do this conversion, the IRS makes you convert a proportional piece of your old IRA too, and that can trigger a massive, unexpected tax bill. So yeah, these are definitely not beginner moves. A mistake can be really expensive, which is why it's a really, really good idea to talk to a financial or tax advisor to make sure these are the right moves for you and to help you do them correctly.
Okay, let's wrap this all up. We've talked about maxing out your 401k, using that incredible HSA, harvesting your losses, and even some advanced strategies like asset location. But you got to realize these aren't just a random list of tactics. They're all pieces of a much bigger strategy. The whole point is to consciously and deliberately build a financial engine that's not just powerful, but also super efficient, cutting down that tax drag every step of the way.
At the end of the day, the single biggest takeaway from all of this is pretty simple. Knowing this stuff is only half the battle. The real power comes from actually doing something about it. So looking back at what we've covered, what's your first step going to be? Are you going to go bump up your 401k contribution right now? Or maybe check if you're eligible for an HSA? The clock is always ticking in investing. The real question isn't just about how much your money can grow, but how much of that growth you're actually going to keep.